Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So just another Velocity Banking review, and also just another excuse to put Tupac on the thumbnail. So just to kind of mix in some of Tupac's messages and songs and Velocity Banking at the same time. It's funny. I was never a big fan of rap when I was growing up, but even if you didn't like it, a lot of the stuff that you heard back in the day had such an iconic status, and that's why, like, even after the people who made it passed away, it's still getting millions and millions of views, right? Tupac's been dead since 1996, right? And then people still listening, and that's how you know your icon status. Tupac's never even heard of YouTube, kind of like Bruce Lee and Notorious B.I.G. That's how you know you're iconic, and you don't even have to like the stuff. But I've been listening to it more because I watched Scary Movie 3, and then the aliens are invading the White House, and the president and his fellow constituents are listening to Tupac. It's like, I gotta listen to some Tupac and, let other people know what I've been doing, and also mix it in with some velocity banking, which we're gonna do today. So if, you've been drowning in debt, keep your head up. Like, not gonna lie. If you talked to me when I was in the year 2015, 16, man, I was only making 20 grand a year. And I was like, one day I'm gonna get out of this and I'm gonna be so rich I won't even know what to do. And back then for me, being rich was making like 40 or 50 grand a year. And now I'm at a point where I paid off a mortgage under 3 years. So everything above that 40, 50 grand mark is kind of like the cherry on top. And, if I can make it, hopefully you can too, right? So keep your head up. All right, so let's go ahead and do velocity banking. What is velocity banking? All it is a debt payoff strategy using your line of credit as your main operating account. And we're just going to do a simple scenario today. Simple scenario. Two credit cards, an auto loan, and a mortgage. So we're assuming that for whatever reason we don't have student loans. Maybe we got a decent job without a student loan, right? And I think, nowadays people are catching on. I don't know, because, sometimes I thought like the next generation after us would like take an alternative path, but whenever I talk to the youth, they seem like even more dedicated to going to college, even though there's less opportunity for them than even my generation. That's kind of weird, right? How conformist our society has become. And I remember like back when I was a kid, being a youth rebel was the thing, and nowadays it's like I don't even know what to call it. It's just a big blob. There's no ideology. It's just I think that's why nihilism is so prevalent because most people their existence just they feel like it has no meaning, and one of the reasons why it has no meaning is because there's no real values to share. And that's why I make these videos a lot. Like, it's like we have these values to share. And one of the things that we want to be is in control of our money. And when we are in control of our money, we can be generous. One of the reasons why I think so many people are selfish and is because they actually struggle with money, right? It's why, you always see in the news stories about people committing crimes because, they feel desperate. They don't know what to do, right? All right, so what a random tangent. So two things in order to do velocity banking, and actually this was from something else, so I should erase this. This is actually from our live stream that we did yesterday, actually. But let me just go back here and erase that. So two things. Number one is we need a budget for velocity banking, and our budget is essentially our debt attack plan, right? Income, expenses, leftover savings. And to be honest, this $581 is actually better than the average person according to the Federal Reserve because they've done studies for like 10 years about can the average American weather a $400 storm, and most of them cannot, right? So we have our expense down. So we have two credit cards, auto loan, and a mortgage. And the whole point of this is that we get rid of the debt to increase our cash flow, right? And then number two is a line of credit as our main operating account. So here's the thing about lines of credit, right? And I'm probably going to get a huge line of credit soon. Although today I actually did get an increase of 3,000, I think $600 in my Chase Amazon credit card, and you have to get it when you don't need it, right? So it's almost kind of like life insurance, right? I used to sell life insurance, and it's really cheap when you're young, and then every young person thinks, "Why do I need life insurance?" And again, I used to sell it, so it's like, well, why do you need it? Well, I think I understand like the mentality, like, oh, you don't need this, but it's so cheap, and you know, there's all these benefits, and then as people get older, they realize the value of it, and then it becomes harder to get, right? So same concept with banking and life insurance and credit. Banks don't lend people who need money, right? So again, I have a $15,000 personal line of credit that I need to use more. To be honest, I always show this off, and I've barely used it. It's a 15% interest rate, and I got it when I didn't need it, right? So I'm just going to assume that we have access to this 15%, $15,000 personal line of credit. And what is a line of credit? All it is a financial tool where you could borrow money, pay back, and then use it over and over again, right? That's all a line of credit is. So even better than a credit card in two ways is that you got lower interest rates, right? So credit card interest rates are like, what is it, 20 to 30%. But the other thing is that you can use it to pay anything. So when you go into the bank's website with a personal line of credit, you click a button and then money is dumped into your checking account, and then it's going to be accruing at a 15% interest rate, not daily. So in order to calculate the daily rates, 15 divided by 365 usually. All right, so and there's all these calculations which I'll show you about the average daily balance and blah 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 blah. But here's the thing, not all personal lines of credit are the same too. I got one from Truist, right? And I try to dump some money into my bank account from Truist, and then Truist says, "Oh, you can only do this before 9 p.m. Eastern on a business day." I'm like, "What's up with that?" So again, every per even there's always going to be little differences between banking products between banks and different lenders, right? So it's kind of like fast food restaurants. Like just because you go to McDonald's, you don't know how Burger King's like. So always, always ask the lender what their terms and all that is. So sometimes I learned the hard way, but it's okay. I have $287,000 in lines of credit. So if I get a bad line of credit, whoop-de-doo, not a biggie. All right. So we assume two things. Number one is the same income. And then number two, we're doing the exact opposite of what Dave Ramsey teaches us to do, which is we're not going to save money, right? Not no save money, no bueno, right? So we're also gonna redo our expenses in a way, and we're going to have something called cash flow, which is income minus expenses. So in the beginning, this cash flow number looks exactly the same like the savings number, right? You might be like, what's the difference between that? Like, Jerry Seinfeld, what's the deal? So what you do is in the beginning, we're going to make the line of credit as our main operating account. And by simply doing that, we're going to increase this cash flow number, right? So let's say we have these two credit cards, 13 grand, let's move it to the line of credit. So we do that, and then guess what happens just by simply doing a debt transfer? We're not eliminating the debt, we're just transferring it, but we are eliminating the payments. Okay, so this goes to zero and this goes to zero, and now we almost pretty much doubled this because so we went from $581 to 1,000 in one swoop, and we even make more money. Why? Because we're putting our entire paycheck into the line of credit, so into the entire $4,500. And again, the actual velocity banking strategy is the paycheck into the line of credit and then expenses out of the line of credit, right? So some people think, oh, do you have to do a direct deposit? No, you just overpay the line of credit, put your entire paycheck in, and then what? Two things: it takes care of the minimum monthly payment, and number two, because the line of credit interest is based on that average daily balance, right? Um, when you dump that entire 4,500, isn't it going to be at the lowest average or balance? So it'll lower that average daily balance. So all right, so that's pretty much the strategy. And then after every single month, it's the cash flow, not the savings, the cash flow. Because after every single month, the savings, you're getting a savings or checking account statement that's going to be zero or near zero. Because every time I get an email from the bank, say, hey, your new statement came out. And I looked at it, I was like, oh, well, it's almost $0, right? So it's all about perspective because most people would freak out about that. I'm like, if it's not zero and I have debt to pay off, I'm going to be a little bit worried. Like, what am I doing with $1,000 that's idle in my checking or savings, right? So that's the difference between the average American and the velocity banker. So here, we can see that we're kind of struggling and we need to keep our head up. And again, if we watch these videos, practice over and over again, just we'll get rid of our debt and then we'll feel like we can sleep at night, right? And I know there are a lot of you out there who watch these videos and it's like, man, I cannot sleep at night. I get you, man. I used to feel like that back in the mid 2010s to even like 2019, right? That was a very hard time. You know, I know that the reason why people are struggling is because, you know, and this is not even just a finance problem. It's just that people don't care about each other anymore, right? Okay, so now let's go ahead and calculate the next month's balance, which is the previous month's balance plus the previous month's interest. And then you subtract that cash flow number, 1016.21. And then let's go ahead and take the average of these two numbers to estimate the average daily balance. And then we multiply it by 0.15, which is that interest rate, and then you divide by 12. Remember, interest rates are quoted annually, and then the statement balances are calculated monthly, so you divide by 12. All right, so now let's see how many months it takes to pay off that line of credit, and it's going to take us 14 months. So 14 months, we good? And let's go ahead and do that. And so 14 months to pay off 13K. Not bad, not bad. All right. And then now we got to figure out, all right, well, are we going to focus on the mortgage and we're focus on the auto loan? I'll tell you what, I know a guy who I recently talked to. I really wanted to teach him this, but he was telling me about finances and he has like I think a 2% mortgage. And he was like, I should pay that one off first because it has the biggest balance. And I was like, what? Like it didn't, you know, whatever. Like it didn't make any sense to me. But um, basically, and let me go down here. There's two types of debt payoff criteria. There's, you know, the general one that I was originally taught was like, oh, you look for the one with the lowest balance, highest interest rate, and highest payment. And usually most debt fits in two of the three criteria. But the one that I like to use is a formula called cash flow index. And I didn't start using it until people randomly started sending me their spreadsheets, and they had like 15 to 20 debts. And I was like, how do I figure out which one to debt to which debt to pay off? This is too much. Like I can't use this criteria. And then it's like this cash flow index gave me this easy ranking system to help me figure out which debt to pay off. And so what it is you take the statement balance. So for example, 22,000, that's the auto loan balance, and then you divide it by the payment, 410.15, right? And then let's do it with the mortgage. So it's 200,000 divided by 1073.64. And as you can see here, we have a lower number, and the lower number is the one you want to pay off. And how big the number and what range the number is will determine what we should do with it, right? So if you have a really big number, you don't want to put the whole thing in a line of credit like a mortgage, right? I talked about that in our exclusive live stream for 99 cents. So if you want to be a YouTube channel member, I actually did a live stream about that. Okay, so now we know from the cash flow index, this is the one we want to pay off. And what does that cash flow index mean? Well, it means even though this has a lower interest rate, right? If we pay off this $22,000, we get $400 back, right? Whereas in order for us to get $1,000 back, we had to pay 200,000. That's like what, 10 times this amount, but we're not getting 10 times the payment of the auto loan, right? It's like 2.5. So it's like we get more bang for our buck for paying off this 22 grand. Okay. So let's go ahead and just figure out what the loan balance is. And actually, this is this loan balance calculator that I created. So if you know the original balance, the interest rate, and the loan term, Excel can auto calculate the payment. It's really cool. I don't have to. I used to do it by going to like bankrate.com or loan or calculator.net, but I don't want to go and switch website windows. I'd rather do it here, and then just the balance of the current balance. So it's like, oh, 5 months passed. What's the balance of these loans, right? And then also we'll calculate the cash flow index and how much interest you've paid too. So let me just do this. I probably need to make the formula neater so when display it doesn't give me an error, but whatever. But you see, like after 5 months have passed, this is the amount of interest, and there's like a interest formula called cumulative interest, not this, you pervert. All right, so now let's go ahead and do this and figure out what the balance of the loans are. And then this is going to be at 14 months. So month 14, month 14. And so after a year, we paid about $1,000 of interest, right? And so one of the things that you'll notice is that our line of credit is only about 15,000, right? And we don't necessarily have to envelop the whole, like move the whole loan into the line of credit. Like it's not necessary. We can use something called a chunking method. And so let's say like, oh, we move like $5,000 of the loan into the line of credit and then pay it off. So for example, this will be like 12.299.45 or this auto loan. And why would that be? Because we move, let's say $5,000 into this line of credit. And then how long will it take us to pay that off? Right. So maybe about cut 1, 2, 3, 4, 5, 6, about 6 months to pay off that 5,000. Now here's the other thing too, is that we're still making the monthly payment. So I always like to use our velocity banking calculator to accurately estimate how long it'll take to pay off that auto loan. Now here's the thing, velocity banking is not a substitute for uh, making more income, right? It's a cash flow management and debt payoff strategy. So I've done simulations where it's like I make $10,000 of income and I actually am negative 10,000 or not negative 10,000. Like I have $10,000 of income, $10,100 of expenses, and it's much easier to get out of debt even though you're negative cash flow than someone who makes like 3,000 or 4,000 a month and you're paycheck to paycheck or you're positive cash flow. More income is always better, right? It's just about how we use that extra income, right? So let me go ahead and open up that velocity being calculator spreadsheet. Give me one moment. Okay, here we go. So we have the velocity banking calculator, and you might ask, like, where did I get this? I got this from Renatus, but for some reason I can't see the logo. Oh, there we go. There we go. All right. So I got this from Renatus, which is where I originally learned velocity banking from. And full disclosure, I'm an independent contracted marketer of Renatus, meaning I sell it and then I make commission off of their educational products. So, all right. All right. So let's go ahead and just put this in. And so I put in all the car loan information, as you can see right here. Whoopsie. Let me go ahead and zoom. Income 4,500, expenses so $2,000 of our general expenses plus the mortgage, right? And so we just exclude everything except for the loan we're trying to pay off. We have the 15% line of credit. The chunk amount is just how much we're moving to the line of credit. So we'll just do somewhere around our income. You know, some people ask like, what's the best amount? Usually the best amount is, in my opinion, just a low amount, right? Like you don't have to put the entire thing in a line of credit because you're moving a 4.5% loan into there, right? And so unless there's a significant amount of cash flow that comes from paying off that loan, and 410 is a good number, it's you'll find it funny that, and this is kind of weird, that a low balance that gets moved to the line of credit, rarely, even if it's a higher interest rate, does not really affect it. So let's move 5,000, and then we can see it took us 1 year to pay it off, and we saved about $904. And the thing about the car loan is that because the car loan is only 5 years and has a low balance, unlike the 30-year mortgage where you're dealing with hundreds or $200,000 in a 30-year loan, the even if you just paid it like monthly for 5 years, it wouldn't have been that long. And even if we pay it off early, the amount of interest that we save is under $1,000, which is, it's good, but not as great as paying off the 30-year mortgage quickly because the 30-year mortgage, the interest is quite insane. All right, so let me just kind of play around with other chunk amounts. So we'll just do 6,000 and see. This should increase if we do 6,000. Yeah, you see that? And then 7,000. Yeah, 8,000. Let me do 8,000. So that's why I say that you don't really need a high chunk amount. And let's do 10 grand. And then 15,000. Yeah, yeah. So if we use that whole line of credit at 15,000, then, all right. And that's because the chunk amount is almost like the least important thing. What's more important is this cash flow. And again, because in the beginning we don't have that much income and we don't have that much cash flow to begin with, that's a lot tougher situation than, if, like I said before, you make $10,000 of income and you have $10,500 of expenses, right? So I know a lot of times we just focus mostly on that interest rate, but I think another lesson that we have to understand is that we have to make more income as well. And a lot of people, this is what I noticed about a lot of people, they think they're fixed at that level, right? And if I had that attitude when I was making 20 grand a year, oh my goodness, I'm stuck here. Um, I would have never be where I'm at today, right? Like I just wouldn't. And so, so the thing is, it's all about attitude as well. And again, if you think, you're gonna make it, you probably will. Because I never had the like, even though when I was making 20 grand a year, I never had the attitude like, oh, like it's over. I just thought it sucked, but I'll get through this, right? So let me just move this here, 5 grand. So about 1 year. So it takes us about 1 year to pay it off, and then let me go to the other spreadsheet. Let me switch this. Okay, and so it'll take us 1 year to pay off that car loan. So that would be 14 plus 12. That's 26 months. Okay. And then 22 plus 13, which is 30, 35K? 35K. Okay. So we got rid of the 35K. And then now we have the mortgage. So now this is zero. And then what's our cash flow now? It's $1,400. Okay. And now we just apply the same strategy with our mortgage where we just, you know, take it away in chunks, right? And so let's take a look at our loan calculator. So this is now going to be zero, right? So this is gone. And then 26, after 26 months, right? What's the current balance? It's 193,000. So we didn't really, after paying the loan for about 2 years, we paid 21 grand in interest, which is insane, and we chipped away $7,000 in principle. All right, so now let's go ahead and move back to the velocity banking calculator and just fill in the data. All right, so let's go back here, and then we start. So this is a 30-year mortgage at 5%, and then this is 200,000. 200,000 and 193,415.41, 193,415.41, right? And then payment amount is 1073.64, 1073.64. And then now we just gotta just put our general expenses because the loan payment is right here, so $2,000. And let's see how long that takes. 7.9 years, so we save about 122 grand in interest. Okay, well, not bad. So now let's go back here to the other spreadsheet, and then let's fill in that here. So and then 26 months and 26 plus 7.9. So what we do calculate is 26 plus 7.9 times 12. No, I'm sorry, we gotta multiply, we divide by 12 plus 7.9 to find out the number of years, or what number of years goes into 26, and then we just add 7.9 years because that's how long it took us to pay off the mortgage. And then so in about 10 years we're debt free. 10 years debt free. Woohoo! I wonder, even if you're at this income level, if people will actually give you a mortgage for $200,000. Right? But I think what would happen is that they would only grant you this $200,000 mortgage if you had no other debt, right? But if you did have like these two credit cards and the auto loan, I don't think they'd give you that mortgage. They'd say your DTI is probably too high or something like that. All right, so now we're debt free, and so this is now going to be our cash flow, which is 2,500. So even if we do pay off our debt, it's better. We're in a much better position. So again, keep your head up, right? But at the same time, even 2,500 a month is not that much, right? So again, this is where we have to think about wealth generation strategies or income generation strategies as well as debt payoff. Too many people just focus on the debt payoff, and I think it's because of their limiting beliefs. They believe that they can't make more money. And again, life just beats you down. And I think one of the other reasons is that people just don't support each other anymore. Like, it took me years and years of my life to realize no one's going to support me. And that's why I moved from California to Atlanta. Because every time I open my mouth, it's just like, oh my goodness, like, you're an idiot. And again, this isn't something I discovered yesterday. It's been going on for probably more than 10 years. And it's just kind of sad that, we used to live in this innovative society where people like Tupac would spit out dope rap, even though I don't like rap as a genre or never liked it as a kid. And then now we just have rehash of everything and no inspiration, right? Like the Star Wars movies. Like every new Star Wars movie is essentially just looks to the previous Star Wars movie as inspiration, whereas the original creator George Lucas, when he created Star Wars, he was taking inspiration from so many things, from like 1950s Flash Gordon serials, history itself, World War II, Vietnam War. He's taking inspiration from everything to create Star Wars, whereas like new Star Wars films, they're just like no inspiration because it's just like a copy of the past because the people who create it now don't know what made Star Wars great, right? So random, what's it called, rant. But yeah, so hopefully, even if you're at this position, you could keep your head up. So yeah, debt free in 10 years, but maybe even faster if we make more income, right? All right, well, that's it for today. Have a great day, everybody, and we will speak next time.